Hi, I'm TaxMax. Let's break down today's tax topic.
In part 1, we looked at why adjustments to trading profits exist and the most common costs that are not allowed for tax. In this part, we focus on the other side of the picture. Allowable business costs, mixed business and personal expenses, and the boundary between trading expenses and capital allowances. For corporation tax, a trading expense is generally deductible if it is incurred wholly and exclusively for the purposes of the trade. This is a legal test, not an accounting one. The question is not whether the cost helps the business, but whether it is incurred solely for business purposes. Common examples of allowable trading expenses include staff wages, employers' national insurance contributions, rent for business premises, utilities, insurance, marketing costs, professional fees, and routine repairs. If a cost meets the wholly and exclusively test and is revenue in nature, it is usually deductible in computing taxable trading profits. Problems arise where an expense has both a business and a personal element. These are known as mixed expenses. Where a cost is partly business and partly personal, the personal element must be disallowed. Only the business proportion can be deducted for tax. For example, if a phone or internet connection is used partly for business and partly for personal use, only the business proportion is allowable. Where the business and personal elements cannot be separated, the entire cost is usually disallowed. This is a common trap. Some costs may feel business-related, but still fail the test because of an inseparable personal benefit. Clothing is a classic example. Ordinary clothing is not deductible, even if it is worn for work. Protective clothing or uniforms with a clear business function may be allowable. Another area that causes confusion is subsistence and travel. Business travel costs are generally deductible. However, travel between home and a permanent workplace is treated as private and is not deductible. Temporary workplaces and business journeys between workplaces may qualify. Capital items must also be dealt with separately. If a company buys or improves a long-term asset, such as equipment, machinery, or fixtures, the cost is not deducted as a trading expense. Instead, tax relief is given through the capital allowances system. Capital allowances spread tax relief over time, or in some cases give immediate relief depending on the type of asset and the allowances available. This is why capital items are removed from trading profits during the adjustment process. Timing differences also play an important role. Some expenses are deductible only when paid, not when accrued in the accounts. Others may be spread over time for tax, even though they are recognized immediately in the accounts. Understanding whether tax follows accounting timing, payment timing, or a separate statutory rule is essential. Bringing this together, allowable costs reduce taxable trading profits, but only where strict legal tests are met. Mixed expenses must be apportioned or disallowed entirely if apportionment is not possible. Capital items are excluded from trading expenses and dealt with under capital allowances. And timing rules mean that the tax treatment does not always match the accounts. In part 3, we'll finish the picture. We'll work through a practical AZ list of common adjustments, pulling together everything from parts 1 and 2 into a clear reference you can use in practice. I tried to expense a personal habit once. The tax rules said it didn't add up.
Educational content only, not advice. Rules can change.